It is hard to believe that we're already halfway through this year. But alas, here we are. I'm making a video that's taking a look at the companies I plan on purchasing in July. So together, let's take a look at what those companies are. Let's see how they're performing. And I'll tell you why they make a perfect fit into my portfolio. And hopefully, maybe they might make a good fit for you as well. How are you doing? Well, I hope you and your investments are doing well. Quick introduction. My name is Steve. And I am super excited for the new Black Widow movie that's coming out next week. It's going to be different. I'm going to be watching it with my daughters from the comfort of our own living room, which doesn't feel quite right. Hashtag I still love you, Cineplex. On this channel, I make videos documenting my dividend stock investing journey. And I like to share some of the different things I've learned as I go along the way. So if you are into that kind of content, you are definitely in the right place. So let's get right into it, shall we? The first stock in my list for July is Bell Canada, ticker symbol BCE. If you're unaware of this company, which I find unlikely, they're a major telecommunications company and they have a market capital of roughly $55.2 billion. Now compare this to TELUS, which is $37.8 billion, or Rogers, which is around $33 billion of market capital. That difference continues when you look at the revenue in 2020. Rogers reported $13.9 billion in revenue and TELUS reported $15.3 billion, while Bell Canada reported $22.8 billion in 2020. Since I am primarily purchasing stocks that pay dividends, it's important to look at that dividend history, which in Bell Canada's case, it's great. For the last 10 years, their dividend has seen growth. It's currently paying out quarterly a dividend of 87.5 cents per share, which is up 5% over the year before and up 28% over the last 5 years. This is important as we want to make sure that we are buying stocks that see dividend growth, because that way we see an increase in our yield on cost, which is a measurement of dividing the current dividend price of the share divided by the original cost that you purchased it at. Their dividend yield right now is their dividend yield right now is 5.76%, which is the highest of the telecommunication companies, which is obviously then very attractive. Plus, I think it's safe to say that this company is not going away anywhere anytime soon. They're making huge investments in their 5G network, investing $4 billion annually. Just in the month of June, they made huge expansions out into the Atlantic province. Their BCE's beta score is currently 0.32, meaning that there's not much volatility going on with this stock. It's not really growing with the pace of the S&P 5000, but just it means it's a very safe stock, and you shouldn't really expect any major increases or decreases in the stock price, which again is also kind of nice and reliable. Now, this next company is actually a partner of Bell Canada's for building that actual 5G network, and that's Aecon Group. Aecon was a company that I added to my portfolio when I was looking to make sure I had a good diversification of stocks. You know, at the time, it was very heavy in financials and utilities. So this one was, Aecon was in construction, so it's like, okay, that's far away from the other ones. Aecon provides construction, infrastructure, and development services to private and public sector clients in Canada, the United States, and internationally. They are currently paying out a dividend of 70 cents per share, which is a 3.92% dividend yield. They have increased their dividend payout consistently over the last 10 years. In the last year, their dividend increase was roughly 10%, and over the last 5 years, the dividend actually has increased by 60%. Looking at their charts, it appears to be pretty sporadic. A 40% drop in stock price in October 2016, and again in May 2018. The 2017-2018 price fluctuation was because of the government of Canada blocked the sale of Aecon to a Chinese construction company, citing national security concerns. So it had nothing to do with how well the company was performing, only that the stock price surged 58% on the takeover news and dropped once the whole thing fell through. Since then, though, it has had steady stock price growth, only to be halted by the pandemic. But even with that, it has had a solid recovery with a price on par with where it was before COVID. As well, their beta score is right now 0.92, which makes it very, very stable. One being it's kind of growing with the S&P 500. Before I share the last company, I just want to know if by hitting the like button, you enjoy this style of video. As well, I want to know what stocks you're planning on buying in the month of July. So leave a comment down below. And now that this YouTube business is over with, done, let's keep going. The final company I want to share with you today is Diversity Royalty Corp, ticker symbol DIV. So starting with looking at their stock price chart, this is a company that hasn't quite recovered yet from the pandemic, making it a great company to buy now as there is growth in their future. This company is a multi-royalty corporation which engages in the acquisition of royalties from multi-location businesses and franchisors in North America. It owns the Mr. Lube, Air Miles, Sutton's, Nurses Next Door, and Oxford Learning Centers trademarks. So you'll recognize some of those company names I just rhymed off, and you'll know that there is a direct correlation to how well those companies are doing with the state of the pandemic. As lockdowns end and people start commuting more, Mr. Lube is sure to see more business. And as consumer spending increases as well, so do the promotions and the reward miles increases that Air Miles is part of. So there's some growth there that we should still see hopefully this year. What I don't like about this company is that it is so tied to the success of us defeating this pandemic. Not a lot of new franchises are going to be opening up, so therefore there's not a revenue pool for the company to grow from there. Although they have managed to increase their revenues throughout 2020, despite the previous quarter seeing a bit of a dip, their net income has been in the negatives, and only just recently have they kind of started to see a positive net income. So it'll be really interesting to see how they perform in this coming quarter if they are again becoming to see if they're more profitable. And then not surprisingly, because of all that, their beta score is a 1.76. So there's a lot of volatility with this company because it is tied to the pandemic and the recovery and the economy kind of getting going again, which, oh boy, is anybody's guess. What I do like about this company is that they do pay a dividend payout of roughly 7.52%, which is roughly a cent and a half a month, or 20 cents for the year. Now, when you look at the dividend history of this company compared to the other two, it's not as stable. So March 2020, they had to drop the price of their dividend. But then even when you look back, there's a 4-year period where there was no dividend increases whatsoever. This would be a position I see myself only holding for 2 years, taking advantage of that monthly dividend income that I can reinvest as quickly as possible into other stocks. But who knows, if the company does really well, if that volatility rate improves and the financials and their cash flow and their revenue kind of all sort themselves out the next 2 years, you never know, it might keep it longer. So why are these companies right for me? Well, Bell Canada only makes up right now 2% of my overall portfolio. So because they pay such a high dividend yield, I want to see them grow actually to be roughly 10% of my overall portfolio, making them more of a cornerstone of the portfolio. The only thing that pains me is that I will have to pick up this stock above my average buying price. But if I want to grow that, you got to pay the piper. The second stock, Aecon, the reason why I'm adding it to my portfolio is it makes up a smaller percentage of the overall portfolio, so I want to grow that diversification. But the other main reason is that it is currently, the stock price is below my average buying price. So again, that's in line with the different rules I've kind of set out when I'm trying to reinvest my money into stock positions I already own, that I invest in ones that I'm buying and average it down my cost, as long as I'm not reinvesting into a company that already has a very high, is a higher percentage of my portfolio. And finally, Diversity Royalty Corp is a good purchase for me because it again makes up 3.8% of my portfolio, so it's on the low end. And because of those monthly dividend payments that they give, I can then reinvest those dividend payments quicker on that monthly basis into other positions and just keep growing the portfolio at a faster rate. Check out that video if you haven't already, where I talk about the 3 different rules that I use when I'm reinvesting into positions that I already have. So that covers my plan for July. I won't be picking up any stocks this week, so it'll be interesting to see how much of this plan can stay intact depending on what the markets do this next week. But with that said, if you're still here, I want to wish you a happy Canada Day. Whether you're celebrating or taking the time to reflect on this holiday, I hope you're staying cool. I hope you're staying safe. And until I see you in the next video, keep it in the green and take care. Bye.